Hey Jeff, how are you?
Great, Paula. How are you?
I'm great. Um,
Thanks for
I
having
just
me.
want to, I want to introduce Jeff Gooderman to our session this morning. Jeff and I are good friends. I met him back in 2018. Um, one of the kindest and biggest supporters I've ever met. You can find Jeff on equities.com. We have every single one of his videos from fintech.tv on equities.com. We transcribe them and we summarize them for our readers if they don't have time to see that video. Jeff is the partner of Gitterman Wealth Management and the CEO of Gitterman Asset Management. Welcome, Jeff.
Hi, and welcome to our equities.com webinar. I'm certainly excited today to host this panel. I was very thankful for Paula and equities.com for letting me put together this panel because it speaks right to the heart of what a lot of our investment themes at Gitterman Asset Management are. So I'm really excited to talk today. We have been focused on these themes for a while, water for a very long time, but certainly grid infrastructure and uranium through nuclear as well for the past year or two. And we work with all three of these folks, and I'm certainly really happy to have them on the panel and dig into this topic today. I think one of the questions that we get asked a lot lately is, okay, what's going to change now since we've been in these themes for, certainly over a year or sometimes as long as 10 or 15 years. What might change now under current administration? And we'll certainly tackle that as well. But first, I'm going to let the panel introduce themselves and talk a little bit about what their company does. So we'll start with Ron.
Hi. Well, first of all, Jeff, thanks for having us. It's great to be on a equities.com webinar. I'll just give you a really quick background on myself and then jump into Clean Edge and keep it pretty brief. I've gone through three technology waves. I've always been interested in sort of which technologies were going to be the most disruptive at any given time. So when I graduated university, I worked in telecom as it was being deregulated in the late 80s. I then worked in the internet throughout the 90s. And then really had always wanted to work in clean energy, clean technology, which is something that we sort of helped popularize that term. But to work in that space, well, it wasn't really till about 2000 that it was ready for prime time. And so in 2000, with Joel McCower, I started Clean Edge, which is my firm. And that firm really focused for many years on convening. We put on big conferences and events. We did a lot of webinars. We wrote reports. I co-authored 2 books. We did everything we could to help NGOs, government agencies, and corporates navigate the clean tech landscape. Amongst all of that, we launched stock indexes because we were already benchmarking the space. And so we did our first index with NASDAQ on US listed clean energy in 2006. 2009, well ahead of the curve on the grid space, we launched our smart grid and grid infrastructure index. And today we also have a water index. We just launched a global water index. So we have a US water and a global water. We have global wind. We kind of cover all of the energy transition and the infrastructure markets related to water and grid. So let me just tell you, we're going to talk about grid mostly today. We got other experts to talk about water and other areas. We'll focus on grid. I just want to give you a quick lay of the land of why grid is so important. A modernized grid is the backbone of the electrification trends that we're seeing right now. There is no way to do it without the network. And so that backbone is what we're going to talk about today. It's what was the theme that we put together now back in 2009. And it's really changing real quick shifts, going from centralized to nodal. So it's starting to look more like the internet with microgrids and VPPs or virtual power plants and communication layers. It's going from one direction to bi-directional. That means I'm not only consuming energy, but I am serving up energy or helping the grid when it's at stressed or having energy storage to help me when the grid is challenged. And the business model is going from consumer to prosumer. And finally, we'll talk a lot about this today, huge shift from conventional fossil fuel energy sources to solar storage, wind, and clean energy as well as some nuclear. So that's what we'll be talking about. And again, thanks for having us. I look
Awesome.
forward to the conversation.
Thanks, Ron. John, I'll pass it over to you.
Yeah, thanks everybody for participating in today's webcast. I'm John Champaglia. I'm the CEO of Sprott Asset Management. I'm based in Toronto. Our firm's been around since the early 80s. We're best known for being a boutique money manager that focuses on metals and mining. We're very unique in that we are a small manager that runs around 30 billion of assets, but we're also publicly traded on the New York Stock Exchange. So we have a lot of transparency around what we do, and we do a lot of novel things that most asset managers don't want to get involved in. We run very large physical commodity funds that cover gold, silver, platinum, palladium. We have the world's largest uranium fund, believe it or not. We also have a physical copper fund. And we also run a whole suite of either index-based ETF strategies that focus on critical materials and mining, as well as a number of active strategies. And today I'm here to talk about nuclear energy's role within the climate-focused transition and energy transition. And as I reflect on it, we started talking about this in 2021. And I very vividly remember at COP26, and right now COP29 is going on in Azerbaijan. And when advocates and participants from the nuclear energy industry participated at COP26, you can imagine some people lost their minds. And fast forward to today, and you've now got over 20 nations pledging a tripling of nuclear power by 2050. So sentiment has changed enormously. Energy policy around the world has shifted tremendously, and that is giving an incredible tailwind to the uranium industry as well as the whole nuclear fuel supply chain. I spend most of my time doing educational presentations to institutional investors that are looking at this space for the first time. In many cases, in 10 or 12 years, the sector was pretty much left for dead. Governments didn't really care about it, with the exception of a few places in the world. And now we've seen a real hard shift back to the technology for a whole bunch of, I think, of very science-based reasons that we'll get into in the presentation.
Awesome. Thank you, John. Mark, Robert.
Yeah, good morning, and thank you again for inviting us to participate. I'm with a group called Water Asset Management. We've been investing exclusively in water since 2005. One of my partners has been investing in water, physical water, since the early 90s. So I came to Water Asset Management after working in capital markets for 20 years. And one of the things that attracted to me was, water is a very interesting investment asset class. Not only is there lots of demand and it's poorly understood, but it is capital intensive. It is largely a series of discrete markets where supply and demand are captive, and it's very difficult to move water large distances to take advantage of pricing inefficiency or pricing differences. And generally, it's been an area where, from a financial point of view, there's been huge underinvestment. There's a large capital spending need just to replace what we've already got or repair what we've already got in the ground, not even talking about what we have to do ahead of us in terms of getting water to communities that have no access to water or sanitation. But also we're seeing increasing demands for water from lots of power development, increased housing demands, increased water quality needs. So you have what we find is an industry which is fairly economically insensitive, that is absolutely essential, that has very limited competition. Nobody's going to rip up a street to put in a competing water pipe or sewage pipe to take advantage of a market opportunity, and it creates impact. So from us, it's kind of the trifecta. The other thing that's interesting is that you have historically been able to outperform most market indices by investing in water, in companies that are well managed, well capitalized, and serving a very, very necessary and difficult to replace need. So for us, it's very compelling. It continues to be compelling, and I think the new administration is going to create some more compelling reasons to continue to invest in water.
Awesome. Thank you, Mark. So we're going to touch on climate change, but it's not going to be the overarching theme of the presentation. But first, I always like to set the stage on climate change because there's certainly a lot of differences and discrepancies and disagreements out in the world of the investment markets and capital markets about climate change. So I just stay very down the middle. What we know for a fact is that it's been getting warmer lately. You can argue about how long that's going to last or about how long that's been going on for, but we know for a fact it's been getting warmer lately. And what we know from science is that for every 1 degree temperature that it gets warmer, it can hold about the atmosphere can hold about 7% more water. And that's cumulative. So for every degree Fahrenheit, not Celsius, warmer that we get, the atmosphere sucks more water out of the ground, which means we tend to have more droughts and more drier soil, more risk of fires. And then, unfortunately, it dumps that rain unlike it has in the past. Instead of doing it over a year, you might get the same amount of rain the next year, but get it all at once rather than spread out over a year. For those of you that are listening in from the Northeast today, we're having the longest drought in the Northeast that we've seen, I think, historically, maybe for as long as we've been record keeping. Really no rain in October. We're already in the middle of November and no rain in November. And we're dealing with forest fires on a daily basis. Over 537 burning in New Jersey and New York right now. So the world is changing from a risk-based standpoint. And what I'd like to pose, and we'll give each speaker a chance to respond to this, is how is that changing hydrological cycle that we're dealing with impacting the investments that you're making and the need for the investments that you're making? And I'm going to actually start with Ron. Since water is at the center of my dialogue, we'll finish with Mark on this conversation, but I'm going to start with Ron on this one.
Sure. Well, thanks. Well, certainly there's no room for climate denialism. And Jeff, in my view, it's science-based reality that we're facing huge climate disruption. That said, at Clean Edge, we've always seen climate as one of many drivers. We didn't get into the clean tech space with climate being our main driver. It was really a whole host. We actually had the 6 C's in our first book, which included climate, cost, China. There were a whole bunch of drivers. Today, if I look at the spaces that we track, in particular, let's focus on grid and energy transition, both. It's the declining costs. It's the pure economics that are driving the shift. So we'll talk a lot about that over the next 45 minutes or so, whatever we have here. I think that if I look at the other key drivers very quickly, climate is one of them. That's resulting actually in investments. So we see much more money for the last 8 years. More money has been invested in energy transition than fossil fuels for the last 8 years. This year, energy transition investments will be at their highest level ever. So that's one thing. The other area for us is aging infrastructure. We have in place grid infrastructure, water infrastructure that's been around for decades, sometimes 50 years or more. So the need to replace that infrastructure is critical. We're seeing load growth unlike any time in history right now with this. We'll talk about that a lot today, but computational demand, onshoring, all the stuff that's happening. So there's this huge need for grid infrastructure to meet all that load growth. We're seeing 3 times more renewables that will likely be deployed by 2030 from the last COP. Now, we may only get to 2.5 times, but it's a lot of more renewables coming online. And then we have these learning curves I talked about, where solar and storage are now the cheapest forms of energy on the planet. Solar is the cheapest electricity on the planet. So I think that climate, obviously, anyone who's interested in this space looks at climate. We were concerned about clean air, clean water. Our name is Clean Edge. That was important to us. But it's all these other drivers that are really just as important. And I would add one last thing just for anyone as an indexer. We've never been an ESG indexer. We are a positive screening indexer. We have an index in Europe that tracks our grid index. It's a UCITS. So it's a fund that tracks our index. They ran an ESG screen against our work, a Sustainalytics screen. One company came out. So I think our positive screening says a lot about how we view the world. So I'll just wrap by saying we're looking for innovation. We're looking for where the progress points are. And in our case, that serves this market well. So yeah, I'll leave it at that. But climate is obviously something that's critical and important, but not our main driver.
Thanks, Ron. I think from our perspective, I got into sustainable investing because of a concern about climate change and mostly a concern about physical impact risk of climate change. And I've been focused on that for the past 10 years. And while there's been a lot of debate, to your point, ESG is really an outward-looking in data set. It looks at how things going on in the world from a social or environmental or governance standpoint might impact the companies you're investing with. It's not a great climate change screen because it's not telling you a lot about the companies you're investing in and their impact on the world outside or their
a lot
supply
of
chain
companies
risks
clear
and other things.
ESG screens that would never make it into our indexes.
Exactly. Yeah. So it's something that we've always been conscious of. John, I'll pass it over to you. Same question.
Yeah, I mean, when we originally got involved in uranium, it was simply about a structural supply deficit, which was a byproduct of an industry that was largely put on care and maintenance as the world kind of shifted away from the technology after, the earthquake and tsunami in Japan in 2011. And we just thought to ourselves, look, you've got a power source that produces 10% of global electricity, 20% of US electricity, and at some point you're going to run out of inventories of the stuff and the price needs to reset. We weren't thinking about climate. We weren't thinking about energy transition. At that time, it was a simple supply and demand imbalance that our thesis was, you either resuscitate the industry or the lights go out for 1 in 5 households in the United States. That obviously has evolved enormously over the last 3 years. I think it was COP27 where the nuclear industry finally got a seat at the table. And that's when governments around the world started to publicly acknowledge they had no way of hitting their net zero targets if they proceeded with plans that had been in the works for many years to close down and decommission the existing fleet of nuclear reactors that they had operating. And unlike countries like China that keep building 4 to 6 new reactors every year, many countries in Western Europe, United States, and Canada were basically letting their reactors just kind of slip away into retirement. And I think I think that the best case study or data point I can share with you was in California back in 2023 when the government there did a massive flip-flop on closing Diablo Canyon, which was the last nuclear power station in the state of California. There was nothing wrong with the power plant. It had been in the works for years to close it down in 2025. And in 2023, the governor did a flip-flop because they finally admitted if they closed it down, the state would be subject to greater risk of brownouts. And that's just because you've got incredible demands growing on the grid for electricity. Think about, we're talking about heat and water. Think about air conditioning. One of the biggest drivers of grid growth is actually air conditioning as the world gets hotter. And think about air conditioning in places like India. As a middle class forms there, you're talking about millions of people that want air conditioners. This is all creating grid growth. This is all creating a lot of demand on critical minerals that basically form the backbone of energy generation, transmission, and storage. And so the thesis has really evolved to a structural supply deficit, to growing demand to meet net carbon neutrality goals. Obviously, baseload power is becoming very, very important. And I think there are some challenges in some regions in the world that not all energy forms work. Land use issues are real in terms of the land footprint, in terms of some of these competing technologies. So it's not a one-size-fits-all solution. I think every part of the world has different endowments of energy and resources that it needs to leverage to meet its energy needs. And we've always been advocates that nuclear is part of the mix. It is the perfect complement to renewable energy. As Ron said, the prices of solar panels have absolutely collapsed around the world, and the deployment of solar around the world is just mind-boggling right now. And we would continue to think that will happen given the cost curve on the technology. But again, you're still dealing with a variable power source, and this is where baseload power comes in as a nice complement.
Awesome. Thanks, John. Mark, I'm going to hand it over to you, but before I do, I'd just like to really bring up what's been going on with some of the storms we've been seeing off the coast. So when we look at something like Helene, which traveled all the way up into the mountains in Asheville, and the rain, as we've just spoken about before, really got hung up there and just dumped an enormous amount of water in a short period of time. And what's interesting is they had, over the last storm, buried their water pipes 15 feet below ground to make sure that if another storm came along, like the one that they had gotten hit with back in 18, I think it was, they'd be okay. And as we know, those pipes all got washed away in this current storm. So I'm wondering, when we have been thinking about water, there's lots of ways to think about it, but for our perspective, it was always around the physical risk of the infrastructure as these storms get worse, as heat impacts piping more than it has in the past in places like Arizona. And I'm wondering if you could include any kind of comments on that in your talk right now. Thank you.
Yeah, I mean, obviously, when we first started the business and back in the, early 2000s, we couldn't even use the word or the phrase climate change. People would throw us out of the office. And it's like, doesn't exist. So we talk about climate variability. And, ultimately, water is really at that forefront, as Jeff has pointed out. It's either too much, too little, and we're not necessarily prepared for it. The infrastructure side, storm water and preparing for storm events it's a third rail issue because they're unpredictable. They require a huge amount of capital to be deployed well in advance of the event actually happening. And it's in areas where, may or may not have been historically, relevant. So it is going to become a big factor going forward. I think you're already seeing the insurance markets as a transmission, device of risk. Large parts of this country are now becoming uninsurable. And whether it's for fire, whether it's for flood, whether it's going to be for these extreme weather events, whether it be tornadoes so it's the transmission is real and the risk is real. And I think it goes to the point that we like to make is I think the early stage of climate investing, a lot of it was about mitigation. I'm going to continue to do my thing over here, but I can buy something over there that's going to make it okay. It's going to compensate for this bad activity. Well, we're well beyond that. Now we're into adaptation, and a lot of these places are going to have to adapt, and it's unfortunately not a cheap prospect. The other thing that we don't focus enough about is, even in the North Carolina debacle, their wastewater treatment plants got taken out. So not only the physical infrastructure, but the water system itself, the water quality. As we know, the focus on water quality was never, it was always assumed your water was drinkable, and it really was kind of external events that happen every once in a while. But now it's not a foregone conclusion that your water is safe. And so this idea that you're going to have to invest more and you're going to have to rely on systems which are properly treating your water for all the, whether it's PFAS, whether it's heavy metals, whether it's, antibiotics, whether it's pharmaceutical products, there are an increasing number of risks to water quality, which we can add to the infrastructure. So look, the good thing is these problems are solvable, and they will require more physical spending. And I think the value of water as an input to one's daily existence has been underappreciated for a long time, and you're going to have to pay more for it. But when you think about water bills, they're still relatively affordable compared to cable, internet, other things, which, quite frankly, you can find cheaper alternatives too, or you can live without, but water you can't live without. But I would focus on adaptation, and most of the systems in the world, most of the water systems that exist today are owned by governments or local government entities. And at times, they have been preoccupied with other capital spending needs. And it's not because they're ill-intentioned, but sometimes they've been distracted. And so we've seen a lot of forestalling of necessary CapEx that, quite frankly, is coming to haunt us in various places, but all solvable, and provides for what we think is a robust investment opportunity. And then the energy demand, we're talking about energy demand and the fact that solar has gotten cheap. Solar is, quite frankly, we are seeing an explosion of demand. We own, in our other part of our business, we own private assets in water. We own a lot of physical agriculture with water rights in the West. We're seeing an explosion in demand for land with access to water for the siting of power, both traditional and sort of newer forms of power. So a lot of people have thought of power demand increasing, but not a lot of people have thought of the corresponding water demand that goes with it.
Awesome, thank you. Again, for those that don't know, at Gitterman Asset, we've really had a focus on climate, and our focus has been historically on the physical risk of climate, so not the really transition risk of climate. We looked at this problem about 10 years ago and really decided that a lot of countries and the political will to transition away from traditional energy sources was just not there, and therefore physical risk would exacerbate, and these hydrological cycles would speed up in their amount of variability. And what we didn't foresee, which is really one of the main reasons for this particular panel today, is how this little known thing at the time called AI would basically throw, gasoline on an already burning fire. We traditionally have had about 2% energy growth demand. We are looking at numbers from most of the big energy associations at somewhere between 6 and 10%, depending on who you talk about, energy demand increases going forward. That means building of data centers and all of these things that really impact you using AI. I think the average person doesn't even understand, every time they use ChatGPT on their phone, how much water they're actually using. There's a big disconnect in this world between something we do on our phones and the ultimate environmental impact of that. So I'm going to start this time with John, because obviously we've seen this explosion in nuclear take place over energy demand issues, and AI is really right now at the center of those issues. And maybe you can talk to how that's impacting, as we've seen lately, every tech company coming out with a nuclear deal, it seems, weekly.
Yeah, and as you said, I mean, we would have never have foreseen that playing out, and it's really happening very quickly. And it does feel like a bit of a domino effect as more and more big tech companies are announcing different arrangements. But maybe I think it's important to take a step back. And, from the US perspective, if you look at load growth over different cycles, we had periods of huge load growth after World War II. In the last 20 odd years, it's been very nominal. And that's just because, we've outsourced a lot of industries to lower cost jurisdictions in the world. And thank God for engineers that make things more energy efficient. So load growth has been very nominal. If you listen to the analyst calls from major utilities over the last 2 years, they're all saying the same thing. Their customers are asking for more electricity. And that's for a number of reasons. It's not just AI data centers, as somebody mentioned at the beginning of the call. There's a massive reshoring going on that was really a response to COVID and the invasion of Ukraine, where a number of critical industries ranging from semiconductors, pharmaceuticals, defense industries, clean energy technologies, electric vehicles, et cetera, they're all being reshored back to the US to diversify away from aggressive nations. That is creating a lot of demand on the grid. But for AI specifically, just some little facts. Today, it's estimated about 2% of our electricity demand is used for data centers in the United States. The numbers that are forecast in 2030 are somewhere between 7 and 10%. And the reason is the data centers are evolving from traditional, storage in the cloud, doing a Google search, to basically a data center. An AI data center is essentially a supercomputer, and a supercomputer is using enormous amounts of electricity. Goldman Sachs estimates that a AI data center query can be up to 10 times as much electricity intensive as a traditional data center query. So the big tech companies are in a global race to win this AI with other countries and regions in the world. They are realizing that a key obstacle to winning this race is securing power. And it's not just power they need, they want clean, firm power. And they are doing deals with renewable energy companies at a very large scale. And more recently, they've announced a flurry of deals related to nuclear energy, everything from funding the restart of a nuclear power station that's been closed for 5 years, 3 Mile Island Unit Number 1, as well as financing power purchase agreements or doing equity investments in companies that are developing new technologies, which are often called small advanced modular reactors. And these are the perfect, I think, use case for these data centers that are very energy intense. The other thing that's got the tech companies excited is this idea about co-location. And what that basically refers to is instead of getting entangled in the web and the legal battles around building high voltage transmission lines in the United States, why not build the nuclear power capacity next to data centers, or building the data centers next to existing nuclear power stations, which Amazon recently announced just a few months ago with Talon Energy in Pennsylvania. So what this is really happening is signaling energy addition. I think that's the right term, given the growing load factor. It's also, I think, bringing much needed capital to a sector that's been starved of capital for a long time. I think it's also helping to validate the technology. And big tech companies are obviously highly disruptive and innovative, and that's exactly what they're prepared to assist with, this disruption of new innovative technologies through these smaller modular reactors. And it's really building, I think, awareness to the category. And I can tell you that when I started talking about this theme to people 3 years ago, I would get the most simple questions like, are we sure nuclear energy is safe? What about the waste? Now those questions are gone. Now people are trying to figure out how this can really complement the deployment of renewables, which has expanded exponentially, how this could provide baseload power. And again, nuclear power has 0 greenhouse gas emissions, which is why the tech companies are focused on this, because they all have self-imposed net zero targets. And it's really driven by their employees. I mean, you might say that they want to be in ESG indexes and whatever, maybe, but I actually think it's from within. I think a lot of their younger employees are embracing climate change. They're very concerned about it, and they want their companies they work for to become net zero. So it's a very powerful trend. It's Amazon, it's Apple, it's Oracle, Microsoft. They've all announced deals in the last 6 months, and it's really shining a spotlight on this.
Awesome. Thanks, John. I don't know who to go to next. I'm trying to think of the flow of energy, but let's go to Mark for this one, and then we'll finish up on the grid. Certainly water is a huge necessity, along with power for data centers. So maybe you can educate us a little bit on this growing demand.
Yeah, I mean, it depends on, I think sort of a lot of data centers had been initially put in places where they got special treatment for tax credits because, there was an incentive. So a lot of initial locations went into areas that were, probably well sourced in power, and water was less of an issue. What we have seen increasingly is data centers moving away from the sort of DC, Virginia area out to places that have where demand is growing. So Texas, a lot of activity in Arizona. These are very, sometimes water capacity constrained areas. So we're seeing, particularly in Arizona, we're seeing a tremendous amount of demand for data centers, but also for semiconductors, all of which are large consumers of water and which, quite frankly, need to have dedicated supplies. In many cases, these particularly semiconductor fabs can consume a great deal of water, similar to, a small municipality. So it's driving up the need, and the other thing is that with this comes a lot of demand for housing and for the ancillary support, less so for data centers, more so for semiconductor fabs. But you're seeing a lot of growth in areas which, quite frankly, are not terribly water supplied, but are very popular for some of the destinations. I think one of my other panelists talked about the inequity of distribution of power availability or transmission availability. It is certainly the case in water. We're not running out of water. We're just running out of water in places that people want to live, or cheap water. So for us, data center is a driver of economic demand. It's a driver of growth of supply for us. We, from an infrastructure point of view, these places need to have available supplies that they can essentially rationalize the capital spending that they need to make to put these places in place. But it is definitely, I think a lot of people have thought through the power side, not a lot of people have thought through the water demands of these sites. And suffice it to say, a lot of that growth is happening in areas which, quite frankly, are dry.
Yeah.
In theory, they should all be in, if we were putting semiconductor fabs and data centers, we'd put them in, Michigan, upstate New York, Vermont, places where water is less of an issue.
Thank you. Ron, certainly our investment in Grid was really on the heels of the AI trade and how much it would impact the need for increased grid infrastructure. So maybe you can enlighten us about that.
Sure. Well, there's so much to unpack here. So I think first, just to kind of walk through the computational demand of AI, as John mentioned, a simple Google search versus a Chat GPT search query is about a 10x. One of you said that. That's accurate. There are some that may even use more electricity. We may see efficiencies over time, but it's much more computational demand. And most of the estimates we're looking at show that, in 2022, about 3% of total US power demand came from computational data center queries, and we're going to go up to 8 to 10% by the end of the decade. So there's no doubt that there's growth there. And just we talked about computational demand from AI centers and supercomputers and data centers, and we talked about onshoring and manufacturing, which is key. The one other thing we missed, which is critical for power consumption increase, is the electrification of both heat and transportation. So heat pumps, EVs, et cetera. So we have gone from an era, it was pointed out, of really utilities managing power use, deep efficiency. The Japanese led the charge on efficiency, and we didn't see a lot of load growth. Now we see that load growth that you talked about. So this is critically important, and that's going to drive a lot of the requirements for power. That means more investments in transmission lines, more investment in power controls, more investments in substations, more investments in smart meters, all the things that we track in Grid. The other way AI is going to impact all of this is not only on the serving up the demand, but also on the supply side. So making things more intelligent. We're tracking a lot of AI usage on the grid side for everything from virtual power plants that I talked about earlier, demand response programs, dynamic line rating. There's a lot of AI that you can embed in the systems themselves. So it's interesting. We cover both of those, and we get a lot of the companies. Great example would be Schneider Electric is working with NVIDIA right now to optimize data center design for their supercomputer chips. So a lot of interesting stuff that could happen utilizing AI to improve efficiencies. I want to talk about nuclear just briefly. Solar and wind represented about 83% of all new net capacity additions globally last year. That's of all the new capacity additions that utilities put in the ground, 83% came from renewables. I would agree that the variability of solar would be an issue if we didn't have energy storage. And energy storage is what you add on to, and again, we track that in grid to deal with the variability. So I don't disagree that nuclear could play a role, but let's not forget energy storage is a critical component in making sure that the solar power, the variable power of wind, and we're seeing it already in Texas, we're seeing it in California, where this last summer, it wasn't a repeat of 2022 or 2020. They did not have rolling blackouts or brownouts. They did not have blackouts because of all the energy storage they were bringing online, to the amount of about 4 gigawatt of power being brought on onto the grid, 4,000 megawatts. So it's considerable. So I think that, you know, we take an agnostic approach. Nuclear would fit into the grid. The grid would serve up that energy. We need more substations and all that. But I don't know to what extent, like SMRs, for example, and I'd love to hear John's thoughts on this, seem to be still about 10 years out. So maybe 2040, 2050, we see a lot. We can repower and do some interesting stuff with existing power plants. I think John Ketchum, CEO of NextEra, said if every single repowering you could do, even if it wasn't economical, you could do it. It represents about 1% of increased new demand in the US. So there could be some challenges on timelines and costs. And so we're more of a proponent of solar plus storage. That's where we really think most of the growth is going to occur.
And Ron, I'm just going to stay with you for 1 second. How do you
Sure.
think a new administration will impact some of this clean energy onboarding that has been happening and what the impacts might be?
Well, this is fascinating. So thanks. I don't think the grid will be negatively impacted by a Trump administration. In fact, I think the Trump administration's focus on crypto, on onshoring, not that the Biden administration wasn't doing onshoring with IRA, with all the computational demands that would happen through a lot of the policies that might come from the Trump administration, that would only serve the grid. Clean energy may be more constrained, but we ran some numbers in advance of this call and another webinar I'm doing later this week with some clients, and it was fascinating. Under the Trump administration, clean energy and every one of our indexes in clean energy and infrastructure, water and grid, outperformed. CLS, which tracks U.S. listed clean energy, was up 447% under the last Trump administration. Global wind was up 133%. Grid was up 128%. And HHO, our water index, was up 100%, all under the last Trump administration. Well, grid and water did pretty well under the Biden administration. This is counterintuitive, right? Cells was down 57.3% up until November. I think we ran it through November 5th. And wind was down 26%. Grid did quite well, and so did water. But my point here is that would be counterintuitive. If you look at also oil and gas, so if you look at XLE and XOP, they were up dramatically under the Biden administration. 106% for XLE year to date through the November 5th. XOP up 89.6%. How do you that's just incredible. And it was down, they were down during the Trump era. So I think we have to let ourselves understand there are forces way outside of Trump or administrations that do this. The other thing, there's been a lot of call by Trump for drill, baby, drill, right? That's his motto. We are the US today, the largest producer of gas on the planet, the largest producer of oil on the planet. We are making or producing 13 million barrels per day of crude oil in the United States, and we're now the world's largest exporter of LNG. That happened under the Biden administration and the previous administration. So there's not much more room left for drill, baby, drill. We're kind of tapping out at the high end in a constrained environment where OPEC is trying to pull back. So I don't know. I think just a wrap on that.
Thanks,
So that's
Ron.
sort of the performance. I'll wrap up, but I'll just say one last thing. States matter too.
Yeah,
And
for
so
sure.
we saw that in the last administration, California, Oregon, Washington, Massachusetts, they're already positioning themselves. So
Yeah.
I'm a little bit less concerned. And I also see that a lot of the IRA monies disproportionately went to red districts by a magnitude of 3 to 1 at least. Um, and so that's going to be hard to roll back because that's a lot of jobs for battery manufacturing and EVs and other technologies in red districts. So
Thanks,
we'll
Ron.
see.
Yeah. Yeah, and I mean, also Texas, half of Texas's energy production over the last year was clean energy. So there you go. John, I'm going to give you a chance to respond a little bit to some of the things. And also there were some questions that keep coming up in the question box about what is going on with storage of uranium, other issues, but also, look, we're certainly in an interesting situation with Russia. What is going on with uranium production there? There's been a proponent of a Senate bill, I think it was, or a House bill that talked about not using any Russian uranium. So just an overview on where are we at with SMRs, where are we at with the disposal of uranium? Maybe we could send it into space with Musk and he can drop the uranium off on Mars that is spent. So love your feedback on those areas.
Okay. That's a lot of topic. I could talk for about 2 hours on all that.
You
But
got 4 minutes. So.
4 minutes. But at a high level, I agree with Ron. Like, it's been counterintuitive. I mean, the Biden administration has been incredibly pro-nuclear as well as a lot of other clean technologies through, the bipartisan infrastructure law, the IRA, the ADVANCE Act, et cetera. And historically, Republican administrations have been incredibly pro-nuclear. And the reason the Biden administration has been very pro-nuclear is because of their climate focused goals. So we don't really see any wholesale changes happening with the incoming administration. I think it's all about energy addition, and energy addition is going to come from all kinds of places, including natural gas, because it is very abundant and cheap, and a lot of it we're burning because we don't know how to move it around. So I do think it's going to be all the above. Trump clearly wants to be a leader in everything. There is a bit of a fracture in the global geopolitical system that we've enjoyed since the end of the Cold War that is changing a lot of policies and specifically energy policy. So we expect more of the same. Now, will some elements of the Inflation Reduction Act get modified, caps, limits, et cetera, that may favor some things and disfavor some other things? That's very likely. These hard mandates that have been talked about in Western Europe and the United States about, no more internal combustion engine vehicles by 2035. We never thought they were even physically possible to achieve. The supply chains are just not there. China controls huge amounts of the supply chains related to EV manufacturing. And it's simple. I mean, China's a net importer of over 10 million barrels of oil a day. And one of the ways to mitigate against that risk is you shift your fleet to electric vehicles. And so they have very, national security driven and economic reasons why they're doing what they're doing. We have abundant fossil fuels, so we continue to think they're going to remain a key part of our energy systems. But the world is obviously clearly transitioning every year to more and more investments in clean. Sorry, you threw a lot at me. So what would you want me to prioritize after that?
Real quick, we only have about another minute, sorry, but storage issues around uranium, have there been dramatic changes in that? And also the timing on SMRs and some of these investments in companies like Oklo. Yeah.
So just a couple of interesting things as it relates to energy policy and geopolitics. So the US has the largest fleet of nuclear reactors in the world, even though we've built 2 in the last 30 years. China will pass the US in 2030. What's amazing to us is that the US essentially produces almost no uranium on local soil anymore. In the next year or so, that number could get to about 2 million pounds, but last year it was 300,000 pounds against current consumption of 50 million pounds per year. That hasn't been lost on current administration or I would believe the incoming one. It's not just the production of uranium, which is a critical mineral. That is a focus. It's obviously the entire nuclear fuel supply chain, which, by the way, Russia controls huge chunks of it. And there's obviously a tit for tat set of sanctions that each country's lobbying against each other. The US has passed a law in August to ban the importation of Russian enriched uranium. In August, the Russians responded last week and said, well, we're going to withhold exports to the US. And how do you like that? And it's obviously going to pressure the uranium price, which it's starting to do. Longer term, small modular reactors, this is obviously about greater use cases. If you think about very large scale reactors, those are very ideal for powering huge metropolitan centers, given how much output they have. If you think about a data center, if you think about a remote mine location, if you think about industrial application like producing industrial heat for Dow Chemical, for example, you don't need 1,000 megawatts of power. You might need 40, you might need 100, you might need 300. And this is where the concept of small modular reactors is coming in. Everything from producing electricity at remote sites, producing electricity to replace coal-fired power stations, which there are still 300 of them in the United States, and producing industrial heat, producing hydrogen. There's a whole bunch of use cases that are being used. We're about 5 years out before the first small modular reactors are operating. There's actually 3 being built where I live in Ontario, Canada right now by Ontario Power Generation. But there are 80 different designs that are on the board for all these different applications. And they're not all going to come to market, but there's clearly capital, government, and public money that is looking to help move these technologies along, including the likes of some of the big tech companies. So it's not going to have an immediate effect, but the next 10 to 15 years, we could see hundreds of small modular and micro reactors being used, including even shipping. If you think about container ships, just like for military applications and submarines and aircraft carriers, they are run by microreactors. If you think about all the, transatlantic and transpacific shipping containers, they could move away from fossil fuels to microreactors. So a lot of interesting applications that will eventually lead to more uranium demand.
Thank you. Mark, I want to, we might have to wrap up on you, but I'd love to hear from you some of the additional macro factors that are impacting water. And also, just to be clear, maybe you could give people an idea of how you invest in water, because I think it could be a little vague to people. Like, are you investing just in water utilities? Is there more variability there?
Right. So we divide the water world into upstream, midstream, and downstream. So upstream we do through private assets. We own physical water, and we can talk to you about that later. But for this audience, our public equity investments are largely tied to midstream, which is transmission, treatment, and then downstream, which is the last mile delivery, if you will, of water and wastewater services to the customer, be it industrial or residential. So it's really, that market is global, and it's an infrastructure, technology, and regulated utility mix of businesses. We happen to like the regulated utility business. They deliver water and wastewater services to everybody on this call. Some are owned by municipalities, some are owned by private corporations. We invest obviously in the private ones, which are regulated. So they have a very interesting model which allows them to earn a return on capital before they actually expend the capital. What is surprising to many people is that when we talk about the water industry, and particularly at this downstream end on the utility side, is that the vast majority of utilities in this country, in the United States, are not regulated. So they belong to cities, they belong to local governments, and they can do what they want with CapEx, either underspend, overspend, and their tariffs are not set by a regulator. They're set by the town council or some political mechanism. And that is obviously something which can be a good thing, but typically we've seen a lot of pushing back on necessary CapEx in order to fund other municipal needs. So our investment horizon for the public equity world is really tied very much to this treatment, transmission, and last mile delivery and infrastructure surrounding water and wastewater availability. So for us, the big drivers are what's happening with regulations at the state level. So the new administration probably is not going to have much of an impact on state regulation. So that's not going to change. We're driven by, demand for new housing, and we think that's probably something that it didn't matter who was in the White House. Focus on affordable housing and growing housing stock is going to be a big focus, and that's going to drive demand for us. And then obviously I mentioned all the infrastructure that is behind in some of its capital investment cycle, including water is often the most energy intensive user in a municipality. The biggest user of electricity is the water infrastructure for treating it, moving it around, and there's a lot of efficiency that can happen there.
Wow. I can't thank you guys enough. I think we really did a great job approaching some complicated issues and why the investment theme really will be maintained no matter what the current administration. To Ron's point earlier about energy and clean energy and wind, I mean, certainly under the Biden administration, there were impacts of rising interest rates and the war in Russia and Ukraine that impacted a lot of those investment themes. So, you can't really predict how certain investment themes will do under current administrations. That's really almost a fool's game. What you have to look for is long-term trends that are supported by spending. And all three of these themes, and the reason that we like them so much as an investment manager, all three of these themes have very long-term trends, both climate and AI. Neither one is going away anytime soon. And they have a lot of spend coming behind it because the IRA bill and support certainly from large tech companies. So really thank you guys a lot. Anyone that doesn't know a lot about these subject matters, they can always reach out to Gitterman Asset or directly to some of these managers as well. Thank you everyone on the panel. And I will pass it back to equities.com.